things at play here. One is, of course, that President Trump does want rates to be lower because that's generally good for the market. That could be good for parts of the economy and so forth. And he has been open, even before he took office, about wanting the Fed to cut rates. This is not different from what he had wanted during his first term, because back then, tariffs had been happening. There was a little bit of a rise of inflation, but not that much. And the reality is PPI then, annual PPI, and today were exactly the same. And rates were about 200 basis points less. So that's just one data point. But we look at a situation where tariffs were in play, which was a concern to the same chairman of the Fed then, which was Powell, who is the same chairman now. He was actually appointed by President Trump during his first term. He's reappointed by President Biden. So very much a bipartisan effort on the part of presidents for him running the Fed. But rates were significantly lower. And what had happened was, anyway, rates got even more low as we started approaching 2019. So rates were around 225, 250, around the sort of 2018 time period where Trump wanted them even lower. The Fed was concerned about tariffs. Inflation was where it is today. But then they went down to 1.5% by the end of 2019. So they did come down by about 100 basis points in that year. I am not saying this is because Trump wanted them to be lower at all. The reality is there was a lot of problems going on behind the scenes in the banking system. And I think that was more the reason why the Fed began to cut rates and actually increase quantitative easing kind of on the QT or on the quiet at the time. However, taking all of that into consideration and the fact that today we have a situation where, yes, the Fed did not cut rates in January. I did not expect them to. I think the market didn't expect them to. They were very clear in December they weren't going to. And it would have been a very weak statement on the part of the Fed to just go in and cut rates on that basis just because that's what the president wants. They are an independent body. That said, our growth is slowing down. Inflation is really not 100% controllable by the Fed anyway. Certainly not real asset inflation. Certainly not gold, not silver, not oil, not coffee, not oranges. They don't have the ability to control that sort of inflation anyway. They just have been talking about it for the last few years. So I think what's going to ultimately happen is they've projected a 50 basis points cut this year. But I think if you look in totality about what the White House is saying, not saying that's pushing them, where inflation is, even though it could get a little higher, it could linger, but again, it's not that different from what it was back then. And also the fact that we could see growth slowing down as we did back then for other reasons. I think ultimately the Fed will pivot to more of a closer to 100 basis points cut this year, not immediately, rather than the 50 that they've already projected. And it was very interesting to me that when Powell did his Q&A and in the statement that the FOMC released, they didn't really linger on that whole we're only doing 50 basis points cut this year. They sort of didn't really strengthen that statement. So I think that they're going to be looking at the economy. I think that's going to be a reason to ultimately lower rates by more than they say. But I think we're talking about something that's happening more in the second half of the year when rate cuts start to accelerate rather than sort of this first quarter. Yeah, I mean, that's something we're definitely seeing, and certainly among the BRICS banks and their allies. For example, in 2018, when tariffs began, People's Bank of China, their central bank, was holding $1.3 trillion worth of U.S. treasuries. And of course, at the time, the amount of treasuries outstanding was significantly lower than it is now. So as a percentage of our outstanding treasuries, they were holding a lot more. Today, they're holding about $750 billion. So they've effectively cut their holdings in U.S. dollars by almost a half. And they've also increase their holdings of gold to be about 4 to 5% of their holdings. And they continue to buy gold as a sort of diversification play against the US dollar. And they're not alone in this. The Central Bank of Russia stockpiling gold, sort of allies of both, like Turkey is stockpiling gold, Poland is stockpiling gold. Anyone who's effectively involved in really energy and isn't one of the major G7 countries is buying gold in their central bank. I think that's a sort of very long-term way of approaching where gold prices might be in 50 years. I understand the sentiment of it, which is that, we're looking at the possibility of moving towards some sort of a, not gold standard, but some sort of a gold, connection for U.S. debt, and that can possibly actually increase the value of that debt, because again, we're looking at not fiat currency debt, but we're looking at a real physical asset, which is also the reason that a lot of these other central banks are stockpiling gold right now and reducing their amount of U.S. debt. But I do think that we are going to see other central banks continue to buy gold. The whole quantitative easing explosion that happened in the wake of the financial crisis and then the sort of doubling down of that happened in the wake of COVID really certified how central banks effectively print money to buy their own debt. So, for example, the Federal Reserve went from owning about $4.5 trillion worth of debt in the height of the financial crisis in the 2009-2010 area to going down to as much as 3.9 to going back up to 4.1 as we were moving into what became the COVID pandemic, and then double that basically to 9 trillion. And right now we're sitting on about a little less than 7 trillion, which is still significantly higher than it was in the wake of the financial crisis. And what that basically means in practice is that debt, first of all, it's not being used for an economic purpose like growth. I mean, it is literally sitting on the Fed's books. And it also helps the banking system because they can effectively use that debt as reserves with the Fed, get interest for that debt back to them, and know that they have that extra liquidity buffer should they need it, particularly U.S. banks. I mean, of course, this is something that's happened around the world, but the U.S. net of so Japan, that kind of coined quantitative easing, has been the forerunner in this. People's Bank of China does have their own version of quantitative easing. It's just not as clear in terms of how much it is and how it's used because their sort of reporting doesn't sort of delineate it the same way that the Fed reports it, where we can see it quite clearly. That debt has a buffer. And also the mortgage business, for example, which is tied very directly to treasuries, also has that buffer because a portion of that 7 trillion are also mortgage bonds that the main banks effectively used as reserve at the Fed. That's an issue as well because it also means that the Fed continues to subsidize the mortgage market. The fact that their book is so high, I think, means in a way that they do know that the banks aren't 100% secure. If they were, I think they would be selling off more debt and they'd be reducing their quantitative easing by more than they have. And instead, they basically dialed back from last year what they said they were going to do in terms of reducing the book. They kind of slowed it down. So I think that means there's still an implicit help to the financial system. Now, that doesn't mean, and we've written about this, is there are significant bankruptcies coming into the corporate sector, particularly the retail corporate sector, which impact commercial loans. Because what happens is if you close a CVS, or if you close a Walmart, or if you close a Rite Aid, or whatever that might be, then you're extracting your business from that location, which means you're not now paying the rent in that location, which means the value relative to any loan or commercial loan that would be extended because that location existed now goes down because the money's not coming in, the rent's not being paid, they're leaving. So what that means is there's more of a potential for more commercial loan and other types of office loan failures or delinquencies or defaults. And we're already at delinquency levels at the same as what they were in the wake of the 2008 crisis. So they're not good. So all of this, I think the Fed, even though it doesn't talk about it, I think it should be watching. To change the status of reserve currencies is something that takes, half a century. We just know this from history. And the US dollar, of course, has been in play and been the main reserve currency since Bretton Woods. At the same time, it occupies about 58% of global reserves versus 72% in the wake of when we went off the gold standard in 71. So it's definitely declined. And if you add in gold, which we don't because it's not a currency, it's even below that in terms of a percentage if you added gold into the mix. So what the Chinese central bank did was say, but if we do want to play, and they did, they got into the SDR basket from the IMF, so they actually are considered one of the main currencies for the IMF. We have to be a little bit more market friendly and market transparent, so we have to be a little bit more flexible in terms of how we deal with rates like the rest of the market is. They've basically done a lot of that in order to be able to be considered more of a reserve currency. Now, there's still a fraction of what the US is, and this is not something that's going to happen anytime soon. But if we look to digital currencies, for example, they do have a system for a digital one that is inviting other countries and other private institutions to its testing for that particular platform. And so it is offering also technological alternative, which today you kind of have to have as central banks evolve a digital alternative because that's basically where everyone's going. And they do have that platform. So does Brazil with the Drex. They have a platform which is going to be based on digital currency. And the more that gets created and substantiated, the less it's necessary to settle in, at least from a trade perspective, a payments perspective between countries, to settle in dollars, because you're going to be operating really on a new global paradigm. And so I think that is something we're going to see not in the next year or two, but that's something that's going definitely to develop from where it is, which is in final testing phases, to something that actually gets utilized and really transforms how we look at currencies and how trade is done. The reality is that AI has become so omnipresent, and conversations about open AI platforms have become so omnipresent that the need for data has become so much more intense, and the need for energy to analyze that data for AI and so forth has created this whole other knock-on effect. That was interesting with DeepSeek, that the US AI didn't detect it in advance. That seems like a negative point. But also that came out on a day where there was a negative ruling on TikTok relative to China that came out also a week after President Trump, in one of his first executive orders, negated one of President Biden's executive orders, which had said that the government and technology companies should be operating more collaboratively on AI, specifically to reduce risk and for national security purposes. And he actually deleted that with his executive order. And so basically took out of play the ability of technology companies in the US to communicate their AI strategies with the government. Then China comes along and says, well, here's DeepSeek. I find it hard to believe that the Chinese government didn't know about it. The story is that it was a private equity sort of based startup, and that may also be true, but it's hard for me to believe that something so potentially powerful is not something that the government would care about. But either way, the United States basically has gone back on its executive order to have that communication between AI technology companies and the government. So it'll be interesting to see if that changes. I think on the commodity side, I continue to see upside in precious metals, sort of money diversification assets like gold, like silver, also copper and uranium because of the electrical transformation and also energy sourcing. So I see that on the commodity side. I think we're going to hear a lot more about cybersecurity, which is always a big thing. But I think especially as this administration, comes into play, we start thinking about tariffs, we start thinking about any kind of battlegrounds between the US and China. I think we're going to see a lot more coming out of the cybersecurity space. So we're definitely looking at that. And AI is a part of that because it's about keeping the integrity of information and of data.